Good morning, everyone, and welcome to this session again on the subject corporate and economic laws. So hope you have logged in and ready to take all the concepts of this subject early morning. And what a beautiful day to start our day, where we'll have a lot of learnings on again certain new words, new concepts under this chapter, corporate and economic laws. Because till now, whatever you have studied in inter and in final till now, it has been hardcore, purely company law. Here also we'll be covering company law, but then on smaller aspects, individual smaller aspects, and probably a lot of new words apart from the world of board meetings, directors, meetings, auditors, accounts, and so on. So great to have you all here, and let us start with this topic today for miscellaneous provision under company law. So as always, my topics are independent mostly from other topics, very small connection, very light connection with other chapters of this whole subject. So they can be taken independently, and that is the beauty of this particular chapters and topics, where independently we can learn it, and probably there's no such confusion here because it is an independent thing and small provisions and very specific provisions. Not much of confusion out there, friends. So under this, we will be covering mostly section 247 to 252. That is about registered valuer, and then we'll be covering how to remove a company's name from the register. And thereafter, we will have topics like Nidhi companies, dormant companies, 447 fraudulent activities, what is fraud under company law, and then we'll have smaller provisions of government companies and so on. So mix of a lot of things. So let me start first with the latest introduction in our company law about 2-3 years back, concept of registered valuers, friends. So the topics covered are, as I mentioned, there are a few topics. So dormant and strike-off companies, government and Nidhi companies, registered valuer, and 447. This will be our main focus. So we'll be covering in these two sessions today and then on 7th of February. So nature of questions, it will be mixed in the sense it could be a direct question, it could be a case-based scenario. So we will be covering different aspects, case-based scenario also, direct question, and MCQs are always there. They can come from any of the topics. Coverage, I think 4 marks would be sufficient enough for the coverage under this particular chapter. So 4 marks from this chapter, 4 marks from winding up. That really clubs around 8 marks. And then next topic, which I'm going to take, would be the SEBI part. Again, 4 marks from SEBI. So 12 marks questions are fixed. I mean, there's no such confusion out here that the questions from these topics will be definitely asked in the exams. So highly scoring topics, because we know, if we know the provisions, I think the questions could be very simple. So let me start with the first part, friends, valuation. Valuation has been introduced lately from 2017 onwards under company law, and thereafter, once it was introduced in 2017 and then further notified in 2019, it became effective in 2019, though the laws were notified in 2017, but it took about a year or so before the laws became effective. So we have section 247, which is focusing on this world of valuation, 247. Along with that, we have registered valuer rules. So there are 2 aspects which we have to cover, the valuation aspect and the registered valuer valuation rules. So I, being myself a registered valuer, I can vouch for it that there has been a lot of buzz, a lot of activities going in this world, and a lot of opportunities do come in under the world of valuation. So apart from understanding the technical aspects, I think it offers a huge valuation opportunity in terms of building up a career. And let me tell you, friends, it's that once you clear this C exams, To become a registered valuer, you have to further clear one exams. So anyway, let us understand first the concept, and then we'll discuss on the prospects and the opportunities under this whole world of registered valuer. So 247, friends, valuation, I think if you read the company law and if you read some other laws like which is included in your course of company law and economic laws, that is FEMA, that is IBC. So you'll find that in these laws, there has been reference to valuation. Be it that when the company wants to come out with further issue of shares, company wants to go for ESOP, buyback, or they want to take over some other company, or they want to value the intangibles, the goodwill part, the trademark. And under Ind AS, we have also seen that a lot of concept of fair valuation, be it fair valuation of plant and machinery, intangible assets, tangible assets, liabilities. And in FEMA also, when we see there's the investment is done by the foreign partner in Indian company or Indian company making investment in foreign company. So there are a lot of scenarios where valuation is required. Even under income tax, we have seen 11 UA rule is one rule where valuation has been made compulsorily to be done by valuer, not a registered valuer. But yes, in the 11 UA rule, valuation is required in case of transfer of shares. So friends, if you see the world of valuation, probably the list is increasing day by day with more laws focusing on the fair value and a lot of scenarios, a lot of activities when they happen, then the need for valuation arises. So this is the whole aspect of valuation. This is again not an exhaustive list. This is an inclusive list. With respect to the regulatory framework, friends, which laws do mention about the Companies Act today? So we have section 247 of the Companies Act, which focuses on the world of valuation, which became effective from 18th October 2017, along with the registered valuers and valuation rules. They also became effective from 18th October 2017. Then we have the valuation standards, though it is not part of our coverage course. So don't worry about these standards. These valuation standards have been issued by ICAI. So all valuers today are either following ICAI valuation standard or international valuation standards. So there are two standards which are now applicable for all the valuation techniques, valuation which you do under each of the law. So these are the three regulatory framework within the Companies Act. Apart from Companies Act, we have the requirement under SEBI also. Under SEBI, there are certain provisions which mention about valuation to be done by registered valuers. And the Insolvency Bankruptcy Code, which again mentions the word registered valuer as defined under the Companies Act. So when a company goes under insolvency, there is a need for appointment of registered valuer by the resolution professional. Once you study IBC, probably then the topic would be covered out there. So our focus would be only the Companies Act and the requirement under Companies Act and the valuation rules. Now, when you see the Companies Act, I think, friends, there are different sections. Some sections have been covered in your inter course, some are being covered under your final course. But when you read those sections, whether it's section 62, section 42, where the focus has been to raise for more funds, further issue of shares. So whenever the company wants to come out with a further issue of shares, they want to raise more fund, then they have to get a valuation done from a registered valuer. So let's say a company which has been newly formed and now it is trying to expand. For expanding, they need funds, and for raising funds, we all know that there are two modes of finance. World across, wherever you go, there is always two modes of finance. The two modes are equity and debt. So debt has certain kind of limitations because you cannot raise debt beyond a particular level. And beyond that, I think we need to go for equity. So when the promoter, the owners, they want to issue funds, raise funds either through their own funds or through outside or through institution, whatever the mode may be, they will issue shares, and then the shares will be issued at a price, and that price will be determined by the registered valuer. So this is the concept under 62. And therefore you see there, when you read newspapers, when you watch TVs of the financial channel, you will come to know that the company, the new startup has issued funds or raised funds of 1 billion from this particular institution, from this particular fund. Probably that 1 billion valuation has been done by a registered valuer. Otherwise, how will you determine the value of the company? Probably there is some basis, and that basis is given by the registered valuer on what basis the valuation of the company is done. So section 62 is one major section, friends. Then 230, where we know that there is an provision for merger and amalgamation, compromises, and when there is a merger and amalgamation, we all know, you must have studied in strategic financial management also. The companies will issue shares to the other company, there will be an exchange of shares between transferor and transferee company, and for that we need to determine the exchange ratio. And that exchange ratio determination has been based on certain criteria. There are specific ways of determining exchange ratio. One is based on the fair value of the shares, and that fair value will be determined by the registered valuer in case of the merger and amalgamation. So we need to submit a valuation report whenever we do a merger equation where the exchange ratio has been determined by the registered valuer. So that is another area where under company law, the valuation requirement has been mentioned. Apart from that, there are section 281. So 281 again is we have discussed in winding up, where the report has to be prepared by the liquidator. Now, when the liquidator prepares the report, we know that he has to determine the details of the asset, including their location and the value. So that value will be determined by the registered valuer. So the valuation of the asset has to be done by the registered valuer. So that is again another area where valuation report has to be submitted. Along with that, in purchase of minority shareholders' stake, valuation will be done by a registered valuer. So these are four prime areas. We have to do the valuation under ESOP every year to determine the amount which is to be written in the P&L. So in that case, we have to do the ESOP accounting. For that, we need to determine the fair value of the shares. That may be determined by a registered valuer, though not a requirement under buyback, but then you may take a valuation report under buyback at what price the company should buy back the shares. So there are different scenarios, friends, where the valuation has not been mentioned, but on the safer side to account for proper entries in the books of account, I think we should always have a valuation report from a registered valuer. So this is the scope which has been mentioned in the Companies Act, though we are talking about 247 only. I was just trying to make a references under which particular sections the requirement for registered valuer has been given under company law. If you go to the IBC part, not focusing much, there has been a compulsory requirement under few regulations of the IBC, where the RP, the resolution professional, will appoint a registered valuer as per requirement, and there too there is appointment of each category of registered valuers. So not going to details, because once you go through IBC, probably you will be having a fair idea. So let me start with section 247, friends. So people who have joined in, if they can send me a message so that I can understand that yes, who are the people who have joined in, and if they want, they can raise their query also on the query box. So friends, valuation by registered valuers, section 247. 247.1 says that we need to cover valuation of, under this particular act, if we need to do valuation of shares, stock, properties, securities, debentures, goodwill, any other asset, net worth, liability. So whenever we have to do valuation of any kind of asset and liability under this act, it will be done by registered valuer. So specific requirement of valuation of all assets and liabilities, friends, very important, liabilities also. Now you would wonder, sir, what type of liabilities are required to be valued under this particular act? And why liabilities are valued? We can understand, yes, valuation of asset is fine, but then why liabilities are to be valued, friends? If you are aware about, let's say, warranties, guarantees, where we need to do fair valuation of all these warranties, guarantees, and loan also. At times, loan also is being valued at fair value, because there may be a situation where you need to present the loans at the current state. So not necessary that always asset has to be valued, friends. It can be liabilities which may require valuation also. There has been scenario, friends, where the liabilities have not been valued, and because of non-valuation of liabilities, companies have raised huge liability in due course of time, especially the contingent liability part. So it is very important that whatever liabilities are there, they should always be valued at the current state, that today could be the liability if there is any scenario. So it's all about valuation, giving the fair value to all the assets and liabilities to present a proper picture. Now, this is important, friends, where 247 talks about that all these assets and liabilities will be valued by a person having such qualification and experience. So they mentioned that it should be done by a person who should have a specific qualification. Now, what is the qualification and experience? That has been mentioned in the rules, which we will discuss. And he should be registered as a valuer. Now, registered as a valuer, that means I need to do some registration. I need to register myself somewhere. Then only I will be termed as a registered valuer. Only by having a qualification and experience will not give me the right to become a registered valuer. Apart from qualification and experience, I need to register myself through some authority, and then only I will be nominated as a registered valuer. So when you register as a valuer, that means you need to be a member of an organization recognized. So here again, friends, as we become member of ICAI, once we clear the exams, here also we need to become a member of an organization which has been recognized under the Act. So in India, there are more than 15 organizations which have been recognized, of which we can become a member. Member of what? Member as a valuer. So we need to register ourselves, and we need to become a member and then register ourselves as a valuer. So today we have different organizations. So we have, let's say, ICAI RVO, Registered Valuer Organization. We have ICAI RVO, Registered Valuer Organization. We have ICSI RVO. That means the Institute of Company Secretaries have also come out with their own RVO. Same way ICMAI, they have also come out with their own RVO. So whoever meets the criteria of creating this RVO as per the requirement of the law, they will be eligible to term themselves as RVO, Registered Valuer Organization. And we as individual, as chartered accountants who are having qualification and experience, need to become member of that RVO. And the terms and condition of becoming a member will be prescribed as per law. Terms and conditions of becoming a member will be prescribed as per law. So these are the basic requirement before you become a registered valuer. And very important, the second point, friend, this could be an MCQ based question, where all appointment under Companies Act will be done by audit committee. All appointment under this act will be done by audit committee, and in absence of an audit committee, by the board of directors. In absence of the audit committee, it will be done by the board of directors. So very important, friends, 247(2)(1) and 2, which talks about valuation of assets and liabilities and who can do the valuation. Valuation of assets and liabilities and who can do the valuation. Now, duties and obligations have been casted again, 247(2), which talks about the duties and obligations of the registered valuer. So the duties and the obligations are that He will make an impartial, true and fair valuation, which is very genuine, which should be there always. There's no doubt about it. So this could be an again MCQ based question. And when you do the valuation, he has to exercise due diligence while performing the function as a valuer. So we know what is due diligence. When you do an audit, obviously you do an audit through due diligence, applying all your knowledge, and obviously all the regulatory requirements are fulfilled. So due diligence is basically doing a smaller version of investigation. It's a smaller version of investigation, not with the object of finding out fraud or finding out any fault in the whole process, but extracting information which is required to give an true and fair valuation report. So whatever information which you require, you will do that, apply your due diligence in performing the function as a valuer. And all valuation will be done as per the rules, which we are going to study, the valuation rules, which are the important, the basic underlying source of doing any valuation. And very important, friends, the last point is that he should not undertake valuation of any company where he has a direct or indirect interest for the last 3 years or may become interested in the coming 3 years. So that means now what is the restriction on doing the valuation? Restriction is, let's say if you are an auditor of a company, can you do the fair valuation of any particular assets of that company? The answer is no, because you have an interest in that company. And suppose you do valuation today, you should not become an auditor of the company in the next 3 years. So both ways, either you have been an auditor in the past 3 years, you should not do the valuation of that company. And if you have done the valuation, do not do any other work of that particular company. So it's not only about auditing, it's about having a direct or indirect interest both. So past 3 years and future 3 years. So there is a band of 6 years where you are restricted to do any assignment of that company if you have done valuation, if you are interested in doing the valuation part. So this is important, friends. So important things. First, who will do the appointment? The board of directors or the audit committee. And if you have done evaluation, probably you should not be interested in the past 3 years and the future 3 years. And you will do the evaluation as per the rules. And finally, give a true and fair value of the assets and the liabilities, whatever you are valuing. So the section is very simple, friends. 247 consists of 4 parts, 1, 2, 3, and 4. So the 1 and 2 are very clear that the valuation has to be done by a person who is registered, and the duties and obligation of the registered valuer. Along with that, every section, as in company law, there are so many sections which talk about the penalty, the punishment, the fine, and the damages. So the same has been incorporated out here also. Which talks about the punishment, which mentions that a fine will be imposed. Fine will be imposed of minimum 25,000 and maximum 1 lakh rupees in case you are contravening any provisions of the Act and rules regarding valuation. Along with that, we may have imprisonment of 1 year if the intention is to defraud the company or its members. So there may be a possibility of fine, imprisonment also. Along with that, very important, friends, along with that, this is again very specific to the registered valuer. This you may not find elsewhere or not very common, is that if you have been convicted under 247(3), that means you have been imposed a fine, or you have been convicted, that means you have been imprisonment because of committing a fraud for the company. Then you have to refund the remuneration also, which you have charged from the company, and also pay damages if caused to the company because of your incorrect and misleading statement, friends. So that is again a very important angle where you are liable for damages also. So along with punishment, there may be a possibility of damages also. So remember, this is again a unique section. So it is easy to recall of all the penalty section, because remembering all the penalties under the act is very tough at times. So there are specific penalties which you are able to recall. This is one of them, because here it is about refund of remuneration and the damages also. So I think this could give you a clue of how to remember the punishment or the fine under the section 247 if a registered valuer is not complying with the various laws. So let's have some few questions. Very simple one. I think everybody should be able to answer it. Where a registered valuer has been convicted under 247, then he is liable to pay the refund of remuneration, pay for damages caused to the company and to any other person because of valuation report, both A and B, none of the above. So I think it is very simple. We have just covered it. Refund as well as damages. Refund as well as damages. So valuer under this section will make an impartial, true and fair. So answer is yes, impartial, true and fair view. Impartial, true and fair view. Impartial, true and fair view. Let's take one example. So the board of directors of Tim Limited proposes to appoint Mr. Nirala, an individual, as a valuer for carrying out the valuation of immovable property. In the given case, the board does not have the right to appoint a valuer. It is against the said provision. In fact, valuer proposes to be appointed shall have qualification and experience and registered as a valuer in such manner and such term as may be prescribed by board and appointed by audit committee or in his absence by the board of directors. So remember, this is a scenario where we need to ensure that your answer should be as per the section. So if the board has decided to appoint an individual as a valuer, fine, they can appoint an individual as a valuer. But all the conditions mentioned under 247 and the rules should be fulfilled. And what are the conditions? First, he should be registered as a valuer, having the prescribed qualification and experience, and he should be a member of an organization recognized. So you have to mention all the conditions in your answer. And along with that, you have to mention, if this company has the audit committee, then audit committee will appoint him. Audit committee will appoint him. And in absence of audit committee, the board will appoint. In absence of audit committee, the board will appoint it. So basically, you have to write out the section 247 subsection 1 if any questions of similar nature comes in the exam. 247 subsection 1. Yes, it's not about only the directors. Mr. Udit, I think your question is valid, where if the shareholders have suffered because of incorrect valuation, then also there is possibility of punishment and damages. Because it is mentioned that intention of defraud the company or its members. Or its members. I hope it is clear, Mr. Udit. So the section is very simple, friends. 247. Only one section regarding the valuers. Apart from that, let us see the valuation rules which are relevant for exam point of view. So there are about 21 rules, but not every rule is relevant to all of us. So we'll be focusing only on those rules which are quite relevant. So rule number 1, again, it is just a replica of 247, where it says that valuation should be done with respect to all the assets and liabilities. So there's not much of difference. Now, rule number 2, as always, in all the cases, it talks about certain definition. So definition is only for understanding purpose. It may not be having such much relevance for the exam point of view. So here, if you understand the whole structure, friends, let me just give you the structure so that now the rules become more clearer. So let's say you are a chartered accountant. Now, can chartered accountant become a registered valuer? So we need to refer to the rules. The rules will mention, yes, the CA can become a registered valuer because he possesses the required qualification and experience. Great. So we have the qualification and experience. Now, any CA can become a registered valuer. We'll see the rules. So let's say you are a chartered accountant, so you possess the qualification and experience. So there should be minimum experience also. So the day you become chartered accountant, that does not mean that you are eligible to become a registered valuer. First, you need to get experience, and thereafter you can become a registered valuer. Now, once you are chartered accountants, it is said that you have to become a member of an RVO recognized. So let's say you become first a member. ICAI RVO. You become a member. Once you become a member, or before becoming a member, you need to clear an exam. You need to clear an exam. Exams are conducted by NISM. So there's a separate agency which conducts the exam. And for appearing in the exams, you have to undergo a 50-hour training program, organized by ICAI RVO. So before appearing in the exams, the criteria is 50-hour training program, organized by any of the RVOs. So once you undergo this training, you appear in the exams conducted by a separate agency. Once you clear the exam, you become a member of ICAI RVO. You become a member of ICAI RVO, and you will register yourself as a registered valuer at IBBI, which is the authority. That means it is the governing body of all the registered valuers as of today. Of all the registered valuers, the governing body is IBBI. So IBBI will register yourself as a registered valuers on an application submitted by ICAI RVO, because you have become a member of ICAI RVO. So ICAI RVO will recommend your name to IBBI that yes, he should be registered as a valuer. So you will become a member of ICAI RVO. The registration certificate will be granted by IBBI. You will be a member of ICAI RVO. The registration certificate as a registered valuer will be granted by IBBI, which is the authority. So friends, the whole structure is: first, required qualification and experience, undergo a 50-hour training program, clear the exams, become member of RVO, and then through the RVO, register yourself at IBBI. Register yourself at IBBI. I hope the process is clear, friends. Now, if you have understood the whole structure, remember you are a member of RVO and registration is granted by IBBI, who is the governing body. It is disallowed, Mr. Udit, because you are an interested party. So a stat auditor cannot provide valuation services to its client. But the criteria is that if in the last 3 years and in the forthcoming 3 years, if before that you were interested, probably then you are allowed. So a span of 6 years has been given. The day you do the valuation, from the date of valuation, past 3 years and future 3 years, you should not be interested in the client in any other manner. Chaliye. So after understanding the structure, let us understand the definition now. So we have an authority which has been specified in the central government to perform the functions under these rules. So IBBI is the authority today who will govern all the registered valuers. Now, when you see the asset class, friends, again, see a chartered accountant being a registered valuer. Now, can a chartered accountant do a valuation of plant and machinery? Obviously, the answer is no. We are not an expert on doing valuation of plant and machinery. Can we do valuation of land and building? Probably no. We are not an expert. So it's not only about CA being registered themselves as a registered valuer. There could be engineers also. Who can register themselves as registered valuer. There could be engineers also who could register themselves as registered valuer, because they have the required qualification and experience to do valuation of plant and machinery or land and building. Plant and machinery and land and building. So remember, the scope of registered valuer is not limited to chartered accountants. So that means your question should be, then what will chartered accountants do? Probably chartered accountants will do the valuation of financial assets, let's say shares. So if the company wants to come out with an issue of shares, who will value those shares? It will be done by a chartered accountant who is a registered valuer, or a company secretary who is a registered valuer, or a cost and management accountant who is a registered valuer. So then the engineers will not do the valuation of issue of shares. So there are 3 asset class, friends. There are 3 asset class for doing the valuation. The 3 asset class are land and building, plant and machinery, and financial assets. 3 asset class are land and building, plant and machinery, and financial assets. So now we understand the definition of asset class. Certificate of recognition will be given to RVO. That means ICAI RVO will also get a recognition. Yes, they are eligible to train the members, conduct training programs, CP hours, monitor the members. So they will be given a certificate of recognition. And we as valuers will be given certificate of registration. We as valuers will be given a certificate of registration. And valuation standards as referred to in Rule 18. And a valuer who is registered as a valuer under this Act will be treated as a valuer. See, Mr. Udit, SA 620 talks about using the work of an expert. So wherever required as an auditor, if you think that you require the support of an expert, then obviously you can take the support of the valuer wherever required. Let's say if the auditor wants to have the fair value of the plant and machinery for under Ind AS. So in that case, he may ask for a valuation report from a plant and machinery valuer. So that is using the work of an expert. Okay, now eligibility for registered valuers. Eligibility for registered valuers. Eligibility for registered valuers. Who can become a registered valuer? Who can become a registered valuer? So if individual, let's say if you're an individual, can you become a registered valuer? The answer is yes. First, you should become a member of RVU that we have already discussed. Then your RVO should recommend your name for registration that we have already discussed. You should have passed the examination within 3 years preceding the date of making an application for registration under Rule 6. So only once you have cleared the exams, then only you are eligible to apply. So let's say if you have cleared your exams today, so your examination will be valid till 3 years. Within 3 years, you can register yourself as a registered valuer. But if 3 years have passed by, then you need to again reappear in the exams. Then you will be eligible to become a registered valuer. We have to possess the qualification and experience that we are going to discuss under Rule 4. What is the qualification and experience? And general clauses, you should not be a minor, not a person of unsound mind, not an undischarged bankrupt, or not applied to be a bankrupt, adjudicated as a bankrupt under IBC code. Person resident in India, then not convicted of any offense or imprisonment for 6 months for an offense involving moral turpitude, and a period of 5 years has not elapsed from the date of expiry of sentence. And if you have been convicted of an offense for a period of 7 years or more, then you will not be eligible to be registered. And not levied a penalty under Section 271J. There was a new provision which was introduced a few years back for imposing penalty under for a professional also. So you have not been imposed a penalty under that section. And you are a fit and proper person. Now, these are exam related points, friends. A direct question, the eligibility to become a registered valuer. Direct question, eligibility to become a registered valuer. So if you remember all these 10 points, then I think you will score 100% marks. And 10 points, few are very simple. These 3 are process oriented, which we have already discussed. These 4, first 4. Then 5, 6, 7, and last one are general. And these two are specific. Now, very important, friends, to become a registered valuer, it is not necessarily that only an individual can become a registered valuer. We can register ourselves as a partnership or a company also. So what are the conditions when a partnership or a company can register themselves as a registered valuer? So today, practically, if you see, there are 2 types of members. The first are individual, and second are known as RVE, registered valuer entity. RVE, registered valuer entity. Now, what are registered valuer entities? They are in the form of partnership company or a company. And they've been set up for the objective of providing valuation services, professional and financial and valuation services. If they have any other objective, then probably they will not be eligible to register themselves. They must not be going any under insolvency resolution or an undischarged bankrupt. All the partners and the directors of the RV should not be ineligible under individual clauses, which we have already seen. As an individual, they should be eligible. But if the directors individually are not eligible, then the company will not be registered as a registered valuer entity. Then 3/all the directors, whichever is lower, are registered valuers. Are not registered valuers, sorry. Are not registered valuers. So if 3 of them are not registered valuers out of all the directors, then they will not be eligible to be registered as a registered valuer entity. So if let's say there are 5 directors and 3 are not registered valuers and 2 are registered valuers, the company is not eligible. But if 3 are registered valuers and 2 are not registered valuers, they will be eligible. So these are the conditions for the partnership firm, friends. So we have 2 types of membership, either individual or as a partnership entity. Then the qualification and experience. Now we come to the individual qualification and experience. Now we know that there could be 2 types of membership, and we know that within the 2 types of membership that the directors and the partners should also be registered valuers. So what is the criteria for that qualification and experience? So for the qualification part, if you hold a postgraduate degree in this specified discipline, that discipline has been mentioned. If we hold a bachelor's degree in this specified discipline, or if you are a member of a professional institute, let's say ICAI, ICSI, ICMAI. So if you are having a post-graduation degree, 3 years of experience, CA, 3 years of experience, a BCom degree, a bachelor's degree, sorry, in this specified discipline, then 5 years of experience. So today, the question is, can an MBA do the valuation? The answer is yes, because that's a postgraduate degree. That's a postgraduate degree. So MBA can do valuation. But provided you should have 3 years of experience. Then the rule number 4 has the explanation, giving the details of the specified discipline. So specified discipline will be further notified as and when required by the government. So specified discipline or an equivalent degree which has been notified by the HRD department will be considered, and then you will be eligible for doing the valuation course. So the specified discipline has been mentioned out here. For a plant and machinery, the specified discipline is an engineer in specific area, land and building engineer in civil engineering and specific areas, and for securities and financial asset, member of ICAI, ICSI, ICAIS, CMA, or postgraduate in finance. These are all specified discipline which has been recognized. Why only institutions of India are permitted in qualification? So, Mr. Udit, I don't think so. It's only about institution. As I mentioned, MBA can also become a registered valuer. So, if you are having the requisite qualification, any postgraduate in finance, any postgraduate degree in finance, you are eligible. So, it's all not only about the institutions. Then something about valuation exam. Valuation exam, friends. As I said, the valuation exam is conducted by a separate agency. NISM is one of the agency, which is an agency belonging to National Stock Exchange, which conducts many exams other than valuation exams. So once you have the required qualification experience, you enroll as a for the training program. After completing the training program, you can appear in the exams. The syllabus will be determined by the authority, that is IBBI, and syllabus will be updated frequently. And it's an online exam. Practically, let me tell you, it's an online exam based on MCQ based questions. You need to secure 60% of the marks to clear the exams. MCQ with negative marking. So you need to secure 60%. There's a huge course. There's a vast coverage of the course, including the valuation part, income tax, company law, insolvency, contract act, and various other smaller laws are there. So it's a huge course which people have to undergo again, learn before they can appear in the exams. So that's also not an easy exam. That's a tough exam. And you can appear in the exams n number of times. So that is not a problem. So nothing much in relation to the exam part. Okay. Obviously, Mr. Udit, because it's a course designated in India, so that is why they have made institutions in India. Having an arrangement with any other country where they recognize the equivalent qualification, then it may be mentioned out here that equivalent degree outside the country may be considered as a required requisite qualification for appearing the exams. But they have mentioned only the institutions of India. So today, if the foreign person comes in, probably then he has to take an Indian degree, then only probably he'll be eligible. But if through an arrangement that degree is recognized, so I think within that framework, he should be allowed. Okay, who can become a registered valuer? So one who should not be a minor, yes. Who is recommended by RVO to the authority? He is a member of RVO. Answer is yes. So all of the above, the answer is yes. Who cannot be a registered valuer? A person who has been declared of unsound mind, convicted under section 271 of the Income Tax Act, and undischarged bankrupt. All three of the above. So that is why fourth is the correct answer. Fourth is the correct answer. So when you want to register yourself as at IBBI, what are the conditions of registration? Let us understand the conditions of registration, friends. First is you should possess all the qualification and experience all the time. That is a must. That is, I think, not to be further discussed. You have to comply with all the provisions of the Act, bylaws, and the regulations of the RVO. So you give a declaration that I will comply with the bylaws. Then you will not conduct valuation of any asset class of which you are not a member. We have discussed there are three types of asset class. So if you are a valuer of registered valuer of asset class plant and machinery, then you should not do valuation of land and building, or vice versa. If you want to shift your RVO, let's say if you want to shift from ICAI RVO to ICSI RVO or vice versa, you should take a prior permission for the same. If any grievances are there against you, then you should be able to address it properly. Very important, we should maintain records for at least 3 years from the date of valuation. And in case of the RVE, that is a company or a firm which is a registered valuer, only the partner who is a registered valuer should sign the report. Because we have seen that there may be possibility of other directors also, but then the director or partner who has got the qualification and membership, then only he should only sign the valuation report, not other directors. Remember, all the partners and directors are jointly and severally liable. And in case if there is a removal of a director or partner, you should inform the RVO where you are member and the authority also. So these are the conditions for registration. Conditions for registration, friends. Again, direct exam question. Direct exam question. That what are the possible conditions of registration? Now we have understood the basic criteria now for to become a registered valuer, all the qualification, experience, conditions, and so on. Now, what are the laws or rules which we have to comply when we do the valuation? Actually, we are executing the valuation of a particular company. So what do we need to take care of? So very important, friends, there are few rules, which is the source of your valuation, which sets out the basic guidelines that how you should do the valuation. So rule number 8 is the prime source of telling the valuer that please, if you want to do the valuation, please refer the valuation standards before doing any valuation. So that means referring to the valuation standard is a compulsory requirement because rule number 8 says that, and rule number 8 is part of the law. He should comply with valuation standards as notified or modified under rule 18. As of today, I had mentioned that today we either can follow ICAI valuation standard or international valuation standard. In India, there is only one valuation standard issued by ICAI, and no other institute has come up with their valuation standard. So therefore, either you follow the international valuation standards, which are quite updated. They have been recently updated in 2022. And or you can follow the ICAI valuation standard. Either of the two standards could be followed. And along with the valuation which you are doing, you can take the support and input from other valuers if required. So either you can take input or take a report of other valuers. Let's say for valuing a share on NAV method. And we all know what is NAV method. Total assets minus total liabilities divided by number of shares. Total assets minus total liabilities divided by number of shares. So if you are doing on the basis of NAV, and when you are valuing the total assets, and for valuing the total assets, I need the fair value of land. I need the fair value of the land. And for fair value of the land, I need a report of the registered valuer. I need the report of the registered valuer of land and building. Then only as a registered valuer, I will be able to issue value of the share. So I can take inputs or report from a registered valuer and whose name I will mention in my own report. That yes, I have taken a valuation report of a land and building valuer. His name is this, his registration number is this. So that is basically using the work of an expert. As we have seen in audit, here also we can use the work of an other expert, that is registered valuer. Rule number 8 gives the guideline about what should be included in your report. The contents of your report. Very important, friends. The contents of my report. What should be part of my report? So this is giving you the framework of your report. So whenever you see the valuation report of any registered valuer, you will see these contents. During an articleship, if you come across any situation where the company has issued further shares, as an auditor, let's say, for example, you are doing an audit of a company, and during the period of audit, the company has issued further shares, then as a part of audit documentation, you can always ask the client to give the valuation report as a part of audit documentation to understand at what price the shares have been issued. So you can call for that valuation report, because that valuation report will be submitted by the company to ROC when they submit their form. PAS3 is one of the form for allotment of shares, allotment of securities. So when they submit the form of allotment of securities, along with that form, they have to attach the valuation report. Without attachment of that valuation report, the form will not be accepted. So as an auditor, you can always request the client to submit the valuation report. And when you see the valuation report, if by chance you get an opportunity, please do open up the valuation report and see whether the contents of the valuation report are covered or not under Rule 8. So when you see the contents of the valuation report, you will find that the whole part is divided into three structures. One is the preface. The preface, one. Two, three. Three parts of the whole valuation report. Preface, the body and the conclusion. The preface, the body and the conclusion. So the preface will cover the basic information about the company, about the asset which you are valuing, your own identity, your interest, disclosure of conflict of interest, disclosure of independence, and the basic requirement of when have you been appointed, when are you doing the data, the valuation part, the data for your report, and so on. So this is basically the basic structure of your starting part of the report. And then you come to the body, the actual valuation which you have done. Now, the main part lies here, that how do I do the valuation? As a registered valuer, what is the process do I have to follow to do the valuation? So remember, as rule number 8 says that you have to refer to the valuation standard. So when I refer to the valuation standard, there are the valuation approaches have been mentioned, the valuation criteria have been mentioned. So I need to match those valuation criteria approaches, which approach to be applied to which particular company, when, why, and to apply that company, what do I need to do? To apply that approach, what do I need to do? So for doing that, I may require to do certain kind of inspection or investigation, which is directly taking information from the market, not from the client. Or maybe you want further extra information from the client. So you may conduct any kind of investigation or inspection. Let's say if your appointment has been done by a court because of certain dispute. So in case of dispute, you are appointed by the court to do a fair valuation. And for that, maybe the client may not be able to submit certain documents and for doing that, you want to do certain investigation, inspection carried out at other areas. So if you have done that, you will mention it. All the sources of information which you have relied upon, submitted by the management or the client or not, whatever information. So let's say audited balance sheet, future balance sheets, projected balance sheet, the business profile, any past important material transactions, past issue of shares. So whatever information has been there, you will obtain all those documents and mention those documents, the sources of information in the report. Yeah, Mr. Udit, I mean, a valuation report, though, you can always log on to MCA, and if you find out the document which are attached with PS3, then you can find a valuation report out there. I can also show a valuation report, but then it may again take a lot of time for you to understand. So here is basically the contents of valuation report, which prima facie is covering the practical part of the valuation. So friends, the detail of documents which have been obtained that you list down here. Then the procedure which has been mentioned in the valuation standard. So valuation standard says that there are 3 approaches for valuation: market approach, income approach, and the cost approach. You must have studied in your SFM subject the income approach, the market approach, or the cost approach. So let's say company is a running company, going concern, then you follow the free cash flow method. Remember, under merger and acquisition, you must have studied the free cash flow method, valuation of business, FCFF, FCFE. So that is basically the income method which is being used for valuing a running company. That is as per the valuation standard. If the company does not have any business, only has assets in the form of land, building, then cost approach should be followed. So whatever procedure which you have adopted and why that procedure has been adopted in valuing that particular company, you can mention that. Then the major factors which were considered for valuation. Major factors, let's say for calculation of discounting rate. So how you have calculated the discount rate, how you have calculated the weighted average cost of capital, what is the risk-free rate, what is the beta, what is cost of equity. So whatever factors which you have considered, whatever assumptions which you have made, terminal growth rate, you have to list down all the factors which were considered during the valuation part. So this is basically the actual conduction of the valuation. And the last part is the conclusion, where you can draw the conclusion giving out the fair value of the share, that the fair value of the share is this much based on this method, along with all the caveats, limitations, because there might be certain limitations of your valuation report and you have not been able to, you have totally based your report based on the documents information submitted by the management. So you need to disclaim something. So those caveats, limitation, and disclaimer are listed down here. So this is the contents of valuation report, friends. Very important. And can it be asked in the exams? I'm not sure about the actual report part, but yes, prima facie, if rule 8 is asked, you can cover these points. And we have broken these points into 3 angles: the preface, the body, and the conclusion. The preface and the body and the conclusion part. So this is one part which is covered, the requirement and doing the valuation. Now the eligibility for the RVO part, the registered valuer organization. Let's say you are a member of the ICAI RVO. So what is the eligibility criteria? So it has to be registered under Section 25 or Section 8 of the Companies Act. Section 8, we all understand, is a company not for profit. The objective is not profit. And the sole objective will be dealing with the regulation of valuers of an asset class or asset classes. And it is a professional institute enacted by the Act of Parliament. It should be registered under the Societies Registration Act or an organization set up as a trust under the Indian Trust Act. So what will the RVO do? RVO will conduct educational courses in valuation as per the syllabus. As I said, the 50-hour training program, that will be conducted by the respective RVOs. and they will grant membership of certificate of practice to individuals. That means as a chartered accountant, you will have 2 certificate of practice, one given by ICAI and one given by ICAI RVO. So once you become a registered valuer, you will be a member of 2 institutes. You have to fill fees, membership fees of 2 institutes. You have to comply with all the learning criteria, learning CPRs for 2 institutes. So that means you are part of those 2 institutes. You are pillars of those 2 institutes, and you have to comply with all the guidelines of those 2 institutes. So it will conduct a training for individual members before certificate of practice is issued to them. That means 50-hour training, giving membership, and conducting training before you issue a COP. And it will lay down a code of conduct also for all the members. Code of conduct for all the members. Along with that, it will monitor and supervise the quality of services given by the valuers, and there's a mechanism to address all the grievances and conduct disciplinary proceedings if required against the valuers who are not complying with the law. So this could be an exam question, friends. What is the role of the RVO? So remember, the role is 1, 2, 3, 4, 5, 6. 6 roles, 6 functions to be performed by the RVO. This could be the only exam question. So can a complaint be filed against a registered valuer or RVO? The answer is yes. It can be filed, not a problem. So anybody can file a complaint against a registered valuer or the RVO. It should be filed against in the authority, at the authority, that is at IBBI, and the IBBI will examine the complaint and take necessary action. And if he is found contravention of any law, you remember 247 is already there. 247 is there, and then 469 has been referred to. And further, if there is any false in any material particulars or known to be false, or which omits any material fact, knowing it to be material, he should be liable under section 448 of the Act. So a lot of penal consequences for the registered valuer, friends. That means this profession has to be taken very seriously, because we are governed by rules, and the rules talks about a lot of punishment, damages, and imprisonment. So let's say another example. Mr. Bhola entered into an agreement with his friends and acquired asset in the name of Bhandari Limited by passing a resolution in general meeting. The notice for approval of resolution included the particulars of arrangement along with the value of the asset duly calculated by the registered valuer. Later, the board discovered the loss arising out of incorrect statement in the report made by the valuer. So later on, there was a loss to the company because of an incorrect valuation done by the registered valuer. Can there be a liability on the registered valuer? The answer is yes. The intention was to defraud the members of the company. And when the intention was to defraud the members of the company, remember, he shall be punishable under section 247, 3 and 4. Along with that, if a complaint has been made to IBBI, if a complaint has been made under IBBI, he shall be punishable as per section 469 and under 448 if he has failed to incorporate a material fact for which he was aware of that material fact. So this was all about, friends, registered valuer, covering section 247, from 247 till along with that registered valuer rules. Any questions you have, please raise these questions. In the previous winding up session, I have sent the material to the institute. Probably institute will upload it at the respective places. You can download the same. And there I had covered the MCQ part also. I will upload this material. Again, I will send the material today itself to institute. And accordingly, you can download the same and review it for revision purpose and also for solving MCQ. I'll add few of the MCQs which we are not discussing out here along with the answer. So you can very well refer to those MCQs also separately along with the answer. Right, friends? Great. So if you can just give a message that yes, things are clear on the valuation front, I'll proceed with the next part, that is removal of the company's name. So just to recall, friends, 247. Four parts, 1, 2, 3, 4. Remember basic important things. As a registered valuer, if you understand the chart, that who will be eligible to become a registered valuer, the qualification, the exam, who are the authorities, the agencies involved, the picture should be very clear. The qualification, experience which is required. Who will appoint you? Remember that, the appointment part, the qualification, basic qualification along with specific qualification, experience, 3 years, 5 years. Who will become the members, individual and a company or a partnership firm, the criteria of becoming or registering as a member, the basic conditions. So basic conditions which you have to remember. And then rule number 8, which will talk about the conduct of the valuation. Rule number 8. So no questions. Good. Udit is there, or Salini. I hope there are no further questions on this concept. So moving on, the next section, that is removal of name of the companies from the register of companies, section 248 to 252. Again, quite relevant. In the last 4 or 5 years, the government has become very, very proactive in the sense where the government is taking steps on their own to remove the names of the companies who have failed to meet certain criteria. And we all know that today there are about 13 to 14 lakh companies which are registered under the Companies Act. Maybe more than that, I'm sorry. Maybe more than 13, 14 lakh active companies might be there. There might be inactive companies. So there must be around 20 lakh companies, out of which maybe 5 to 6 lakhs may be inactive. And what should the government do with all those inactive companies? What is the step the government, or even the company, if they want to remove their name, can they do that? So the process has been defined. And if I today want to remove my name from the register of the companies, then it is a possibility. Obviously, this gives us facility to the company for closing down your business. So friends, today if I want to close down the business, there are a lot of options available. The options are first under winding up. Remember winding up, we have discussed that a company can apply themselves. The company itself can apply for winding up. That is one. Then there's the second option today, which we are going to study, of removal my name from the register of companies under section 248. And third could be a voluntary winding up under IBC. So there are 3 processes which are defined now to remove the company's name. Now, which to follow, that is the judgment which the company has to take. And that is the role of a professional coming out and talking to the company and guiding them that probably you should follow this step for following the steps for closing of the company, which is more relevant to your status. So because we have studied winding up, so I'll just differentiate between, let's say if I want to close down a company, under winding up and under strike off, what could be the possible difference? So friends, under winding up, the process is again very cumbersome, which we have studied, coming from 271, applying to tribunal, getting the orders from tribunal, a liquidator is appointed, and the liquidator has to follow certain process. So it's a very big process, long drawn process where a lot of compliances are there. So apart from that, not going into details, but here I think one major difference is that winding up will result in total complete closure of the whole business. Total complete closure of the whole business. And once the company is wound up, if I want to restore my company, then the chances are very less, except what is provided under 356, where a 2-year time limit has been defined that if I want to resume the company, then within 2 years, that may be a possibility. Under restoration, under strike off, the company will be wound up, the company will be closed. But the possibility of restoration exists till 20 years. So at any point of time, within 20 years, if I want to restore, that's a possibility. And the process under strike off, it is not that cumbersome as compared to winding up. So because there's not much of possibility for after winding up, that is why there's a very big process. And maybe under strike off, it can be restored at any point. So the process is short. Not as detailed as in winding up. So it is up to the choice of the company when they want to completely close down without any second thought, that they know that they are not going to start their business, or let's say for example, foreign company which has started their business in India, now they want to completely shut down and they know they are not going to come back. Probably for them, either winding up or voluntary liquidation under IBC is a better choice. More important, under IBC, voluntary liquidation is a better choice, not even winding up. And in that case, strike off may not be a good choice. So how can a company be striked off from the register of members? How can a company be striked off from the register of members? So the modes are 2. There are 2 modes, friends. The first mode is striking off by the registrar, and second mode is striking off by the company. Striking off by the registrar and striking off by the company. So that means today, if I want to wind up, the company can itself apply. And if I am not fulfilling certain conditions, then the registrar may apply for winding up. So 248(1) and 248(2). If you refer to many cases which are pending at NCLT, you'll find that there are a lot of cases which are pending at NCLT referring to section 248(1), 2, and 252. Basically, 252 will be highly referred in NCLT matters. You will find a lot of applications being made to NCLT for restoration of the company. So why that happens? Let's understand the whole process. Let's understand the technicalities involved. So first we'll consider 248.1. 248.1. The 248.1 gives the power to the registrar, friends. Gives the power to the registrar to strike off the company's name. So remember, now we are totally shifting gears. One was registered valuers, which was a totally different angle, and this is different angle. So we have understood. First, today we have understood new terminology, registered valuer, and the concept behind it. Now we are understanding a new term, strike off, closing down a business. These are all new things. So the registrar will apply when he has a reasonable cause to believe. That means he should have sufficient reason that the company should be wound up. And what could be the possible sufficient reason? Let us evaluate that. The company has failed to commence its business within 1 year of its incorporation. The company was incorporated, and within 1 year, it has not commenced its business operation. How will it come to know whether it has commenced its business operations? That is the question, friends. So obviously, the company will file certain documents that it has commenced its operation. And thereafter, we know that the company has to file certain annual returns under section 92. So once reviewing those returns, where the registrar feels that company is not doing any operations, then the registrar, can strike off the company's name. So first, it has failed to commence its business within 1 year. Remember, friends, these are exam question. Direct 4-mark question, the power of registrar. The second, the company is not carrying on any business or operation for period of immediately 2 preceding financial years. And it has not made the application for a dormant status. So one is another concept known as dormant. We'll study that dormant later on. So there are 2 different situations. Within 1 year, the business has not started. And second, at any point of the life of the company where it feels that within the last 2 years, the company is not doing any business. 2 continuous financial year. Then the registrar may strike off the company's name. So within 1 year and during the life, any 2 preceding financial years. The third, the subscriber to the memorandum have not paid the subscription which they have undertaken to pay at the time of incorporation of the company, and a declaration to this effect has not been filed within 180 days of its incorporation under subsection 1 of section 10A. Now, this is a conceptual matter which we have to understand, friends. Though we all know that, but again, just trying to recall whatever you have studied in your concept of inter and trying to relate out here. We all know there are subscribers to the memorandum. When you prepare the memorandum, we have different names. They are known as subscribers to the memorandum, or they can be termed as the founders or the promoters of this company. They may not be the directors of the company, but maybe the promoters of the company. And when they write in the memorandum, they say that, yes, I am willing to subscribe to 1,000 shares of face value 10 rupees each. 10,000 shares of face value 10 rupees each. I am willing to subscribe. I am willing, not I have subscribed. So when the memorandum is prepared, friends, remember, in the memorandum, the name whose name have been covered under the head subscriber to the memorandum, it says that they are willing, they are, yes, agreeing to subscribe. They have not paid the amount. The amount will be paid only when the company is incorporated. Because once you prepare the memorandum, that does not mean that the company has been incorporated, because you have to apply that memorandum and the ROC will approve that memorandum and then they will give the certificate of incorporation. So till the time the certificate of incorporation is not granted, your bank account will not open. Your bank account will not open. So that means your amount cannot be deposited. So ideally, they will only say that, yes, I'm willing to subscribe to the shares of this company. And once the certificate of incorporation is granted by the ROC, they need to submit this amount. They need to prepare a check and submit in the bank account. And for that, they need to file a declaration. A declaration will be filed with the ROC. Yes, we have received the amount from the subscribers to the memorandum. So when the ROC feels that, yes, the subscribers have not paid the amount, there's no such certificate which has been filed with the ROC that full amount has been received, that means the company is not interested in starting the business operation. And therefore, it should be striked off. Right, friends? So here we take a short break. And after the short break, we're going to again restart the concept of striking of the company's name. we are in tune with whatever we are discussing. We are covering the chapter of striking off. Hope the concept till now is clear that why this step is required. See, the step is required because there are so many companies which are not running and the data, the information keeps on piling up. So why not take action against those companies? And if you're not doing any business operation, genuine, I mean, you should be striked off. And if you're doing a business operation, why not comply with the law? So therefore, these steps are very much required, friends. And with the government becoming very proactive, we as consultants should advise our client that if you are genuinely interested in running a business, then do form a company. And if not, do not form a company. And if you have formed a company and you're not doing any business, so if you do not wait for the registrar to take a step, voluntary, you should go and winding up the close down the business. Okay, so we had covered the points, friends, where the no commencement of the business within 1 year, no operations, no business operations in 2 immediately preceding financial years, anytime, right? When the subscriber to the memorandum have not paid the subscription amount. I think that is very clear now, that what does subscriber to the memorandum means and how that process is followed when the company is incorporated. And as a part of the process, remember when you apply for the company as a, you want to register yourself as a company and you want to have a certificate of incorporation, the registrar has got the power to do a physical verification, inspection of the registered office of the company. And when it does the physical verification, it comes to know that yes, company is not doing any business operation. So the registrar, again, based on his report, based on his visit, he can very well close down the business or strike off the company's name. So if you see the whole structure, friends, majority of the steps is within the starting of the business. So maybe within 1 year, you're not commenced business, subscriber have not applied for the shares. After physical verification, when the certificate of incorporation is given and you do a physical verification, it's not basically immediately, but then that physical verification can be carried out anytime. So, and the ROC comes to know of no business operation. So initial years are very crucial. And then later on, if there's no business operation, then also there is a possibility. So in all cases, you are covered, and you think that no, once this time period is over, you do not fall under this category. Well, it is not the case. So first is 248.1, the conditions. When the registrar can take its step on its own. Now, if it wants to take a step, what it will do? What is the step to be taken by registrar for a striking of the company's name? So the step is that he will send a notice to the company and to all the directors of the company, showing his intent that why not remove your name from the ROC and requesting them to send their representation along with copies of relevant documents within a period of 30 days from the date of notice. So that means a form will be sent, which is in the form of STK1. There are rules which have been framed for removal of the company's name. There are rules which have been framed. So there are separate rules which you can refer to. These are more procedural rules. I will not cover those rules except for certain important points. I will cover it here. So STK1 is the form which will be sent by the registrar to all the directors, asking them to make the representation. Obviously, again, as a reasonable opportunity to be heard, which is given here. Now, obviously, registrar would not take such steps or where the stakeholders involved are large, the public is involved. Do you think this step should be taken by the registrar suo motu? The answer is no. When there are so many public shareholders taking a step for closing down a company, which is listed again, would be very detrimental to the shareholders. Therefore, within the rules, there is a provision that this notice cannot be sent to the following categories of companies, and which is very practical and genuine. So which are those companies? We understand very practical, logical listed companies where the stakeholders are much beyond the closely held companies. Now, companies which have been delisted, that means they were listed. Only because they have been, the reason is that because they have not complied with the listing agreements, LODR requirements, or any other statutory law, because of which they have got delisted. But again, delisting does not mean that there are no public shareholding. There is public shareholding, but because the company has defaulted on certain things, therefore they have been delisted. So the basic underlying concept remains same, where there is public shareholding. Be it listed or delisted, both the same thing. New term, friends, for all of us: vanishing companies. Vanishing companies. Which are these companies, friends? Vanishing, which have vanished. Well, Udit, if your company has been formed just to hold shares, then the objective is very clear. I think in your memorandum, the objective will be defined that yes, your objective of the company is to hold shares in other companies and nothing else. That is the investment activity, which I'm trying to carry on. So investment in my group companies. So that is the objective. So once that is the objective, probably that company will keep on running because you are fulfilling the objective of the company. But if your objective is not that, your objective is something else and you're doing only an investment and not doing any operation, that means you're not going as per the objective. So the criteria is that when you're not doing any business operation, it means that basically you are not fulfilling the objectives of the company for which it has been formed. Hope you got my point. So in that case, the ROC will not remove your name if your objective is to make investment in other companies. Because you're doing the job, you're doing that job. Vanishing companies, friends. Now, what is vanishing companies? Let us understand that. Vanishing companies, a company registered under the Act or any other previous law, listed with the stock exchange. Again, the criteria is listed. But which has failed to file its return with ROC and exchange for a consecutive period of 2 years and is not maintaining its registered office at the address notified with the ROC, and none of its directors are traceable. That means they are not traceable. People have gone away. You are not able to find out who are the directors, where is the registered office. Probably these companies were created for the purpose of committing fraud or enticing the shareholders, getting money, but not doing any business operation. That means they should be subject to certain other penal consequences, and that will only happen if the companies remain alive and the companies are not striked off. So if they are alive, probably actions can be taken against the company by the respective agencies. But if they are striked off by the ROC, then nobody can take an action because the company does not exist now. So therefore, there were many situations which arised in not many cases where there were vanishing companies which raised money from the public, but then they vanished suddenly. When on physical verification, it was found that there is no such office, there are no directors, all directors were dummy. It used to happen long time back. Today, it is not so easy to create such vanishing companies. Laws are very strict. People are vigilant. People are aware. So therefore, creating any kind of vanishing company today is very difficult. But when things were not structured, technology was not at its best, many companies were created and practically there was a lot of vanishing companies. So we cannot delist, we cannot remove their name from the ROC, vanishing companies. or companies where investigation and inspection has been ordered. Remember 205, 6, 10. There are so many cases where investigations can be initiated. Or actions on such order are yet to be taken. And prosecutions are pending. The trial is going on at the court, and the court is to decide what has to be done out of that inspection and investigation. Again, notices have been issued under section 206, 207 by the registrar or the inspector, and 208, which will talk about the report to be given by the registrar or the inspector, and the report is pending. Or if the report has been submitted, a follow-up or instructions are pending on the report submitted under 208, then in that case, because there might be certain element of fraud, because 206, 7 investigations are initiated when you think that there is some wrongdoings, misdoings happening in the company. So when the report is pending or report not submitted, you cannot remove the company's name. Again, against which any prosecution or offense for an offense is pending, we cannot remove the company's name. So companies whose application is pending for compounding before the competent authority. Compounding is, settlement process where you have applied for settlement with the government under any compounding scheme. At different point of time, the government comes out with compounding scheme where they ask the company now if there is a 5-year default, and if you pay a lump sum amount of all the defaults, then the penalties could be compounded, and one amount will suffice for all the penalties, and then you can restart your business operations. They will be relieved of all the penal consequences. So in that case, when the compounding process is pending before the law, before any competent authority, then the company cannot be striked off. Companies which have accepted public deposit, again where public is involved, friends. Very natural it should happen. Where public money is involved, the company should never be struck off. Companies having charges which are pending. Now charges which are pending, that means companies have taken a loan. Companies have taken a loan, and when the loan has been taken, and that means there is some liability existing, that is why the charges are pending. So in that case, I think the company should not be struck off. Companies registered under Section 8 of the Company Act. Now, why Section 8 companies are covered? For obvious reason, remember friends, Section 8 companies are not having an objective. So if they are not having an objective, no objective for earning profit motive. So if they are not having an objective, so there is no such case of striking of the company's name. So if Section 8 wants to close down, probably they need to go for winding up process or voluntary winding up under IBC. So this is mentioned under rule number 4 of the removal of the company's name, that which companies are not to be covered under rule number 4. So 248(1) talks about suo motu action to be taken by the registrar. Now 248(2), it talks about application by the company itself. So that means when the company, after extinguishing all its liabilities, by passing a special resolution. Remember, winding up also special resolution, here also special resolution. But here the liabilities have been paid. Under winding up, it was not necessarily that liabilities have been paid. The liabilities might be paid by the liquidator. But here I have to pay all my liabilities. So again, a difference, friends. Under winding up, I find that I'm not able to run the business. I'm passing a resolution that now liquidator should be appointed to wind up the company. But here I have paid my liabilities, I have disposed of my assets, I have paid my liabilities. Not dispose of all the assets, but the question is I have paid all my liabilities. So I'll pass a SR or a consent of 75%. I hope you understand the difference between a SR and a 75% consent of the members in terms of paid up share capital. So both are different angle. Mathematically, both are different. I think we are all aware of this mathematical difference between a SR or a consent of 75% members in terms of paid up share capital. So it is 75% in terms of value, while special resolution does not talk about value. So once a special resolution is passed, they can apply in the prescribed manner to the ROC for removing the company's name on the grounds specified in subsection 1, and the registrar shall, on the receipt of such application, cause a public notice to be issued in the prescribed manner. That means once the registrar receives this particular application, once the application is received, a public notice will be issued in the prescribed manner by the ROC. So ROC will come out with an ad that they have received an application under 248(2). This company wants to strike off, so that everybody is aware, publicly everybody is aware that this company may be striked off, so therefore I should not do any business. And if I have any claim against that company, I need to file for that claim before the ROC and saying that the company has not paid all its liability, my liability is still outstanding. Provided that in a case of a company regulated under a special act, approval of the regulatory bodies established under the act shall be obtained. For example, if it's a banking company under RBI Act, insurance company registered under Insurance Regulatory Act, probably they have to obtain the permission of that regulatory body before closing down a business. So if you are registered under respective other act, probably an NOC has to be taken from the respective agency, respective regulatory body also. Nothing shall be applied to company registered under Section 8, as we have already discussed. So, as business is not the objective under Section 8, so not at all required. So remember, friends, the process either by the registrar or the company. The registrar will send a notice to the directors for their representation, and the company will apply to the registrar, and the registrar will then officially publish it in the official gazette. So at the expiry of the time mentioned in the notice, the registrar may, unless cause to the contrary is shown by the company. Now remember, at the expiry of the time mentioned in the notice, which notice? Which the registrar has sent. Remember, it is talking about 248(1), not 248(2). In 248(2), there is no such notice. It's an application by the company itself. Notice is sent in STK 1 to the directors and asking for a representation, and there's no representation by the company. If there is no representation by the company, and it mentions that within 3 months you have to submit a representation, within 3 months, if the registrar does not receives any representation from the company, shall publish notice thereof in the official gazette, and on the publication in the official gazette of this notice, the company shall stand to be dissolved. So once the notice is sent and no reply received, the company stands to get dissolved. Now, It is not like that, the company will get dissolved very easily. Probably the ROC also has to take certain steps and ensure before giving an order of dissolvement shall satisfy himself that sufficient provision has been made for relation of all amount due to the company and for payment of discharge of its liabilities and obligations within a reasonable time. And if required, obtain necessary undertakings from the directors or other persons in charge of the management of the company. So in this case, remember, in this case, this is a scenario where the company itself is applied. So when the company is applied, the registrar, before passing an order of dissolvement, will ask for an undertaking. Let's say undertaking is given in the form of affidavit, notarized from the directors that all liabilities have been paid off. All amount has been realized and the liabilities have been paid off. So this particular statement of declaration has to be taken from the managing director, director or person in charge. And that is the job of the ROC to satisfy himself regarding the same. Before that, he should not pass an order. Provided that, notwithstanding the undertaking referred to in this subsection, the assets of the company shall be made available for payment or discharge of all its liabilities, even after the date of order removing the name from the company from the ROC. Now, it does not mean that subsequently, if there is any asset which is realized or found with the company, that will not mean that those assets cannot be disposed of to pay off the liabilities. So even after removal of the company's name, there is a possibility that all the assets which come into existence after the removal can be used to set off all the liabilities of the company. Example, income tax refund order, which we all know that it takes time at times. At times, let's say the company has been wound off and the income tax refund of, let's say, previous years are received by the company. Or they get entitled for an income tax order because of any subsequent order of Supreme Court, which may be decided in the course of any proceedings for some other company. But by virtue of that, this company also gets entitlement of certain refund. It happens, you never know what can strike when you can strike gold in all these matters. So subsequently, you are entitled to certain refund, but the company has been closed down, and somebody comes to know of that refund, then that refund will be received, and accordingly, my liabilities will be further paid off. So removing the company's name does not mean that everything gets over. It is all subject to a lot of ifs and thens. Now, let's say the company's name has been removed. So, are the directors, officers of the company, they will feel free? Okay, I'm now free because the company's name has been removed. I'm free from all my liabilities which can come in due course. Even contingent liability can also arise. There is a possibility, you never know. If there is a windfall gain, there could be a windfall liability also. So in that case, the liability of any director, manager who has been exercising power of management and shall continue and may be enforced as if the company had not been dissolved. So the liability may be continued even if the company is dissolved. You are not free from the liability part. That will still exist. Will it remain there in case of winding up? The answer is no. Winding up is a complete death of a company. Voluntary liquidation under IBC is a complete death of a company. But under strike off, we can understand there can be a scenarios. Very important, nothing in this section shall affect the power of tribunal to wind up a company, the name which has been struck off from the register of the companies. Now, even after striking off, can it go for winding up? Exam question, friends. Exam question. The company has been striked off from the registrar. Can the registrar again sumo to file a petition at tribunal for winding up of the company? The answer is yes. The answer is yes. The tribunal will have the power to wind up the company which has been striked off from the register of the companies. This is an exam question, very important. This has never been asked in the exams. But this is a technical point which can become part of the whole case study scenario. So friends, 248.1, 248.2, remember, I hope the process is clear. One sumo to by registrar, you should remember the conditions when the registrar can do that. 248.2, when the conditions when the company can do it. Then the process in 248.1 notice will be sent. Time will be given. After that, a publication in the official gazette will be taken. 248.2, application will be made by the members. And thereafter, the application, the registrar is to satisfy himself with respect to the relation of the asset and disposal of all the liabilities, and the ROC will take an undertaking from the respective management for the same. Even after the resolution has been done, the liabilities of the director, manager, person in charge who has been in charge in the management of the company will still remain there. They cannot be shelled out of their liabilities. And in subsequently, after even the company's name has been striked off, if they receive any amount, any relation of the asset, then that asset relation will be again used to pay off the liabilities. That is also a possibility. The striking off does not mean that the right of the company to receive any amount is over. That will still remain there. I hope these points are very clear, that you have to mention all these points with respect to striking off the companies. 248.1, 248.2, 248.1, 248.2. ROC, which was reviewing the financial statement of White Steam Private Limited, incorporated 8 months ago. ROC found that the subscriber to the memorandum has not paid the subscription money, or not had they filed a declaration to this effect. The ROC strike off the name of the company from the ROC register of companies, comment upon legal compliance. So whether the ROC can do it, we have all studied, we have all understood. It was incorporated just 8 months ago, and we see the condition. Yes, the conditions are very much clear. Has failed to commence his business operation within 1 year of incorporation, or subscriber had not been paid that amount, and declaration has not been filed within 180 days of its incorporation. So declaration has not been filed. So that means two things: subscriber not fulfilling the condition, and company is not able to commence the business operation within 1 year. Though it is not clear whether they have commenced the business operation, but it is very clear that they have not paid the subscription money. Can the ROC take a suo motu action? The answer is yes, the ROC can take a suo motu action, friends. So what will the ROC do? I mean, is that the only answer? Okay, ROC not take, ROC has the right to take a suit to action because the subscriber have not paid the subscription amount and within 180 days and no declaration has been filed. So is that the only answer which we have to submit? Probably no. Once you mention yes, the as per law, this is the provision. Therefore, the ROC is correct in taking that step of removing the company's name. But the question is how? It will send a notice to the company. It will not strike off immediately. The ROC strike off the name. No, ROC cannot strike off the name. First, the ROC will submit a notice, send a notice to the company, asking them reasons, giving them proper time to submit their representation. And if this representation is not submitted or is not justifiable, then the ROC will strike off. Remember, full answer. Don't give half answer that yes, ROC is eligible. No. Follow the process. Then only ROC will be eligible to strike off the company's name. He shall send a notice to the companies and directors of his intention to remove the name and requesting them to send their representation along with the copies of relevant document within a period of 30 days of the notice. That's important. Or as further time may be granted. So there's a non-compliance. The event is triggered off. That does not mean that the ROC has the right to remove the name. Event is triggered off, subject to representation, the ROC can strike off. Any questions, friends? No. ABC and insurance company incorporated with all the legal procedures, but the company cannot commence its operation for a period of 1 year since its incorporation. The members decided to get its name removed from the ROC. The members themselves came up by passing SR or getting a 75% approval of the members of the paid up share capital. Consent of 80% of members in terms of paid up capital, not as SR, but 80% members in terms of paid up capital. Even if there are 2 members who will constitute 80 members, 80%, that is sufficient enough. You don't need to part a SR for that. Thus, an application was filed for purpose, determine the validity of the application. Okay, agreed. So when you see refer to section 248(2), when the company is taking a step, company has taken a step, it has passed and it is not passed a special resolution, but has taken an approval of 80% of the members in terms of paid up share capital. And they can very well do it because of the reason that they are not able to commence its business. So remember, 248(2) application will be made only for reasons mentioned in 248(1). Application for 248(2) will be made for reasons mentioned in 248(1), that they are not able to commence its business operation, or they are not doing any business operation for the last 2 years. So reasons remain same. Process may be followed by the company, not by the registrar. I hope you got my point. Conditions are mentioned in 248(1). So 248(1) tells about the conditions when the registrar can do it. Same conditions when the company can do it. Now here, the only difference is, friends, the company can apply, but again, the event is triggered off after fulfilling certain conditions. And the condition is because it is an insurance company, therefore it must have got registered itself with an insurance regulatory authority. So along with the application, the company has to obtain an approval from the insurance regulatory authority because that's a special act which has been created. So application has been made. If the application was made with the approval, then it is fine. But if the application was made without the approval, the application is invalid. Application is invalid. Is it clear, friends? These are finer points which can come in exams. So please do remember these small aspects, quite relevant from exam perspective. Oh, now next. Next is what? An application under 248(1) shall not be made if at any time in the previous 3 months. Very important. At any time in the previous 3 months. Has changed its name or shifted its registered office from one state to another. Within the state, it is permissible. Again, a very small point, right? But then please do remember. When the company has shifted its registered office from one state to another, or has made a disposable for the value of the property or rights held by it immediately before seizure of trade or otherwise carrying on its business for the purpose of disposal for gain in the normal course of trading or otherwise carrying on the business. That means it has made a disposable for the value of the property immediately before seizure of trade or for any other reasons apart from carrying on the business. That means where there has been an abnormal transaction for disposal of the assets, suddenly you are doing this transaction before closure of your business. Before closure of your business, the business is running and suddenly you dispose of the asset. Your business is running and suddenly you dispose of the asset. For the purpose of any undue gain, then in that case, you are not eligible to apply for removal of the name because that's a questionable transaction. That's a questionable transaction. Has engaged in any other activity except the one which is necessary for the purpose of making an application in that section, or deciding whether to do so, or concluding the affairs of the company, or complying with any statutory requirement. That means during the last 3 months, you have engaged in any other activity apart from the objectives of the company, except for any activity which was required under a law or for making an application. You are doing that activity, that is fine. But engaging in any other activity which is not within the purview of the law and the memorandum, then you are not eligible. So, a lot of circumstances where again, as a particular circumstances has been covered with respect to disposal of asset. Same way could be you are trading a business, you are doing a business in product A, and suddenly you start trading in product B, which has not been within the objectives. But that is only because you wanted to do it because of some other reasons. Then you are not eligible for removing your name. Or an application has been made for a compromise or arrangement under section 230, 232, and the matter is still pending at NCLT for the same. Matter is pending at NCLT for the same. Then you cannot apply for removal. Or if the company is being wound up under the IBC Act. So when already a liquidation application, voluntary liquidation is pending, why do you need to apply for striking of the company's name? Not at all required. So under 249, there are specific situations which has debarred the company to apply for removal of the name. Remember, this is an application on behalf of a company. That means it is talking about specific situation where the company cannot apply. Under Rule 4, we understood there are few companies which should not be striked off, but that was for registrar not to take action against those companies, especially when they are listed. It was about registrar. Here it is talking about an application to be made by the company, 249. Remember, 249 restricts the management or the company to apply under certain situation. See, so B and C are basically points to be covered where the company should not engage in any other fraudulent, not a fraudulent one, but any activity which is subject to certain kind of inquiry, maybe. Apart from that, if it is shifted in registered office, if winding up is being process is pending, and if the compromise arrangement is pending at the court of law. So this is a direct and exam question. A case study could be created out of it also. So these are restrictions for the company to make an application. Now, if somebody makes an application without a, one second. Yes, if the company makes an application in spite of knowing all the laws and knowing that you're not eligible to apply for the application, in spite of that you have made an application, 1 lakh of rupees. 1 lakh of rupees. Right? And the application may be withdrawn by the company or rejected by the registrar if the conditions are brought to the notice of the company or to the registrar, whatever the case may be. So, company, private limited company incorporated in 2013. The company deals in manufacturing glasses in 2018. The company is not carrying any business operations. In April 2020, the company shifted its registered office from Jaipur to Ahmedabad. Jaipur to Ahmedabad, one state to another. 2nd May, the company decided to file an application. 2nd May. April 2020, 2nd May. To strike off the company. The said act will not be valid because application can be valid only after 3 months. So remember, the dates are important. The application has been filed within 3 months from the shifting of the registered office, which should not happen. And therefore, company is not eligible for filing an application under 248(2) because of restrictions made under section 249. So what is going to happen once the company gets dissolved? What is the outcome when the company gets dissolved? So friends, the moment the company gets dissolved under 248, it shall on and from the date of mention in the notice. So whatever is notice has been issued, it will cease to operate as a company. And the COI, Certificate of Incorporation, shall be deemed to be cancelled. And for the purpose of realizing the amount due to the company and the payment or discharge of the liabilities, this subsection shall not have effect. Again, the same point has been defeated. Remember, friends, As I said, if subsequently any amount is received to which the company gets entitlement, then for that purpose, the company will be in existence. That means amount will be realized and liabilities will be paid off. Amount will be realized and liabilities will be paid off. Again, as this whole process is a very sensitive process involving stakeholders' money. So violation of the process will result in penalty, which is obviously should be there, because people may take undue advantage of all this and therefore they may apply for removal of the company's name. Therefore, these are all the restrictions which are there. So penalty under 251, along with that penalty which we have mentioned of contravention of any law, in spite of not being eligible, you are applying to the registrar for winding up. So along with that penalty of 249, So remember 250 will talk about the effect. So that is an exam question again. What will be the consequence of the effect of the company being striked off? Remember, you have to mention all these operator companies, COI will be deemed to be cancelled. And this is important, which you have to mention. This is again exam question of 3 marks or 4 marks. Very small question, very small aspect, but very easy to score, friends. Very easy. Effect of dissolution of the company under section 250. This again may not be that much relevant, but it is one of those odd situations where tough paper is presented in front of you by the examiner. So penalty where the application made by company under subsection 2, remember it is basically by the company. It has been made with the object of evading the liabilities. As I said, it is very important. Why would somebody apply for the company to be wound up or striked off? It is only when they don't want to pay the liabilities, or the intention is to defraud the creditors or any other person. Then the person in charge of the management of the company shall be jointly and severally liable to any person who has incurred losses or damage as a result of the company. Punishable under fraud, 447. We'll study that. And further, the registrar may recommend prosecution of the person for filing of an application. So the registrar has the right to, recommend for prosecution also. So I hope by here everybody is clear in the concept. Any questions, anything which is coming into your mind, friends, please raise your point. Till 251, 248, 249, 250, 251, the penal consequences. Now restoration. Restoration. So when we talk of restoration, that means the company has been striked off. The company has been striked off. And the name has been removed. Is it a possibility to restore the name? So the answer is yes. It is possible to restore the name. So under what scenario the restoration can be done? Again, exam relevant question. These are exam related points. And practically, as I said, when you review all the NCLT cases, you will find a lot of applications being filed under section 252 for restoration. Why this will happen? Because the ROC on its own sumoto has striked off the company's name because of the conditions mentioned under 248. And then when the ROC has taken this step, then the company has to apply for restoration because the ROC has done a wrong step. Why? We can understand the situations where it can happen. First, let us understand the regulation, the provisions, and then we'll cover the practical scenario also. So any person, here the situation is any person, friends, any person who has been agreed by an order of the registrar. Any person who has been agreed by the order of the registrar. may file an appeal to the tribunal within 3 years. Exam MCQ question. What is the time limit where which you can file for restoration of the company within 3 years? Who can do it? Any person. And if the tribunal finds that the removal of the name has been unjustified in the view of the absence of any grounds on which the order was passed by the registrar, that means registrar was not justified in passing that order because of the reasons which the person has given in its application, he will order for restoration of the same. So any person can come in, friends. Remember, out of the blue, you have the new character, as it happens in movie of the past transactions. He suddenly comes in and says that this is wrong and this should not be done. And I'm one of the persons who have been aggrieved by this order. So 3 years is the time limit, friends. 3 years is the time limit. Then restoration by the registrar himself. Can the registrar, exam question, friend, can the registrar restore the company or suo motu? As suo motu, he has removed the name. Can he restore the company's name? That means the power has been given to the registrar itself. He has done the mistake. He should rectify it. Very good. I think that's a very simple process. So if the registrar is satisfied that the company name of the company has been struck off from the registrar either inadvertently or on the basis of incorrect information furnished by the company or its directors, then he may within a period of 3 years from the date of passing of the order. So this may happen under section 248(1) and 2. Obviously, under 248(1), he will not take his action. He will not try to reverse his action unless it is very explicitly a known fact that that mistake has been grossly done. But by virtue of section 248(2), where the company makes an application and on the basis of the application, the ROC passes an order of removal of the company's name, and later on he comes to know of the mistake, or an incorrect information has been submitted by the company and its directors, he comes to know of certain facts, then again within 3 years, he should be able to restore the company's name. So the criteria is, the number of years is same, 3 years. There's no such difference. Any person and the registrar, any person who is aggrieved will go to the tribunal. Registrar suo motu can take the action. Registrar suo motu can take the action. So exam question, friends. Who can apply for restoration? Who can apply for restoration? Any person out of this world can come in? Yes. Registrar on its own? Yes. Now, does any person include the members, the directors, the company, the creditors? Well, very well, yes. It can do so. But here, very important. If a company or member or creditor or workman, company, member, creditor or workman, 4 people have been specified out here very clearly. If they are aggrieved by the order of the company's name being struck off by the ROC, application will be made to tribunal. Expiry of 20 years. And it was proven that at the time of the struck off, it was carrying on the business or in operation or otherwise. It is just that the name of the company be restored for the registrar, or otherwise it is just. It is just, remember, it is just means it is justified. Either you prove that the company was in operation, or you prove that it is justified that the company should be restored for the benefit of all. Then the time limit is 20 years, where you can apply the tribunal, and the tribunal on its application, if it is satisfied to this extent, it may allow the restoration of the company. It may allow the restoration of the company, and the copy of the order will be passed by tribunal, shall be filed with the company, with the registrar within 30 days from the date of order. And on the receipt of such order, the registrar shall cause the name of the company to be restored in the register of companies. And it will issue a fresh certificate of incorporation. Very important. A fresh, because that COI got cancelled. No, that is now cancelled. A fresh COI will be issued by the registrar. So friends, there are 3 scenarios now under which the companies can be restored. 1, within 3 years, any person. Second, by the ROC, if there is an inadvertently mistake being committed or false information being submitted by the directors under 248(2), and the order was made by the registrar on the basis of the application submitted by the company or the directors, then he feels that now the information was provided wrongly and he has got certain information, and therefore this company should be restored. Third, 4 people, the company, the members, the workmen, and the creator. The company, the people, the members, the workmen, and the creator can file its application within 20 years if they are able to prove that the company was running and the business operations were going on when the company was being struck off, or it was justified in that particular scenario to carry on the business or to ensure that the company is running and not strike off. Then the tribunal on their application will restore the company. So once the order is made, then the order will be filed with the company and the registrar within 30 days. And on the receipt of the order, the company will be restored and a fresh certificate of incorporation will be granted. So if you have any questions, friends, please raise. Yeah, Vidula. Yes, okay. So the question is that that the company has filed an application to the ROC for striking of the name, and that MCA side is showing that the process is still there. So till the time the process is on, the company has to file all the compliances. It cannot do away with the compliances because the order has not been made. So till the final order has not been made, you cannot stop for non-compliance of the regulatory requirements. So please keep on filing till the final order is made. I hope it is clear, Vidula. Great. So these are our practical scenarios. Good that you have raised this point, Vidula. This is a practical scenario, and I'm sure all these practical doubts do come in our mind. What was going to happen in this case? What is going to happen in that case? And whenever you have this ifs and thens, remember, whenever you have this ifs and thens, I think that could lead to one case study. That could lead to one case study, because case studies are created because there is ifs and thens. There are ifs and thens. And that is the role of the consultant to clear those ifs and thens. Okay, so the scenario could be, let's say, for example, friends, the company is running and there's no such liability. There is an operation. The company has had certain asset, but there's no such liability. But then company has one land which it has bought for certain future business. But then there's no such business going on. And there's a company is inactive, no operations. Only on the asset side, there's a land, there's no liability. And the company is not doing any operation because of certain dispute which is going on between the management. So there are 2 parts of the management and there's a dispute. And the company is not able to file its return for the 2 years. And there is no such business operations being carried on. Now, when the company is not able to file its return for last 2 years, and there is no actual business operations being carried on, the ROC Sumoto gave a notice, and because of the dispute in the management did not take care of the notice and ignored the notice, and they did not make any representation. And because there was no representation, the ROC published in the official gazette that these are the companies which are being striked off because they are not filing any return and there's no such business operations. And then the company got striked off from the registrar. That was a step taken by the ROC. Well and good. So till now it is going on fine. One sudden fine day, some angel came in, angel like chartered accountants who are always there to hear to their clients, to hear their woes, grievances. And chartered accountants always lend a helping hand to everyone. We all know that. They are very kind and benevolent and humble people. So they go and settle the dispute between the management. The two brothers who are there, they settle the dispute between the two brothers. And the brothers are very happy, and they are very happy because they know that there is a land in the company's name which is there. And now they have a big value of asset which can be used for doing further business of the company. But the chartered accountant informs them, we are sorry that the company has now been striked off because you have not complied because of your internal matter, and non-compliance has led to this particular action by the ROC under section 248(1). So now there's the gloom side of the picture. So the owners, the brothers, in spite of being happy that the matter has got settled between them, but now they cannot get hold of the land because the company is not in existence. But yes, being a chartered accountant, we know the rules. And therefore, you come up with an idea that under 252, it is possible to restore. It is possible to restore the company. And you can therefore apply. Even the settlement has been made after 5 years. It took 5 years, long drawn mediation and reconciliation and arbitration between the two management to settle their disputes, old egos. And now the 5 years have gone by. So the chartered accountant comes in and consults and tells that, yes, even if 5 years has gone by, we can apply under section 252 for restoration of the company, which says that any person, member, the company, the creator, or the workman. So being a member of the company, being a shareholder of the company, or being the company itself, or the member of the company, you can very well apply to the tribunal. And when you apply to the tribunal, you may mention that there was a dispute. You can show the records of the dispute between the two management, and you can show the record of the settlement now reached between the two people and their willingness to run the business as a company. And you will prove that though the business was not being carried on during that particular period when the company got striked off, but it was not justified to strike off the company because the company had got a land which has got value. Company had got a land which has got value, which could be used for running the business, generating employment, and if there was any liability, it could be paid off. So in that case, you make an application under 252(3), 252, and then the tribunal, by hearing all the parties concerned, even the registrar also, it will send a notice to registrar. It will ask the company that please send a notice to registrar, and the registrar has any point to be said. The notice will be sent to the registrar, the income tax department, or various other department to have any say in this whole process. Then the tribunal will issue notices, and the respective parties can come and attend the hearing at NCLT. And after the NCLT hears all the parties concerned, will issue an order of restoration if required, because the land is there. Obviously, it should be restored. And that order will be filed with the registrar within 30 days. And the registrar will restore the name of the company and will issue a fresh certificate of incorporation. This is the scenario which can come in the exam. So this whole story has been built up under the section 252, that whether the company can be restored even after 5 years or not. Is it clear, friends, this whole process now? Great. And so we had covered two aspects, friends. One was the valuation, different perspective, striking off along with restoration, two words which you are now well acquainted with. Striking off and restoration. Striking off, restoration, along with few terms like vanishing companies. Vanishing companies. So the process, again, just to recall in short, then we'll wind up the whole class. 248.1, I hope you all know. 248.1 can be done under what conditions? Except and conditions mentioned in the rule 4 of the removal of the names, vanishing companies and similar kind of listed companies. 248.2, application by the company itself when they have extinguished all the liabilities along with the SR and 75%, whatever the case may be. But the conditions should be mentioned same as 248.1. The reason should be same. Then the application will be made. Registrar then, on reviewing the application, will pass an order. 248.9, where the application cannot be made. Where the application cannot be made by the company. We have seen that these are the situations where the application cannot be made by the company, right? Third, the effect of dissolution. It ceases to operate. Certificate of incorporation deemed to be cancelled, but that will not take away the right of the company to receive any amount on account of any asset and discharge of its liability, even after the existence is not there. That is 250. These are the effect of the dissolution of the company, very important. 251 is all the penal consequences. That is again to be reviewed by you. And then 252 talks about restoration of the company status. Restoration of the company status under three scenarios. One, by any person. Second, by the ROC. And third, by 4 specific people with a span of 20 years. For first two, the span is 3 years. And for the rest people, it is span of 20 years, which is a very long time period to resolve any matter and make the company active. And valuation, I think, which we have already discussed, revised also, that what has to be covered under valuation. So very important topic, friends. In terms of independency, you will see that there is not much of correlation between other topics. You can review it independently. And in short, see, we have discussed in a detailed manner. Probably when you'll review it in exams, before the exams, I think it should take about 15 minutes for you if you have noted the points, important points. If you have understood the whole concept, the important angles. So within 15 minutes, restoration, within 15 minutes, valuation. And that will give you at least option of exploring 4 marks. So 30 minutes and 4 marks. That's a trade-off which you have to do. Because these are very process-oriented specific criteria. And we've discussed a lot of scenarios also. So any questions, friends? Otherwise, we'll conclude today's class. In the next class, I'll be covering smaller aspects again of government companies, which is again a very short chapter. Nidhi companies, which is a bit in detail. So we'll be covering Nidhi companies. And then 447 and dormant company. 4 scenarios, which we'll be covering in our next class. So any doubts along with few MCQs? So if you have any questions, please ask. And I'll be sending the presentation today. No? So Thank you, friends, and for attending today's class. And if you have any query, you can always raise it through mail, through this query board, and send it to BOS also, so that I can solve the same. So thank you, and see you on 7th for the next chapter.